This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
Okay, well, the reason we're not quite there, I hope obviously, is because all those cash flows are in pesos, but it's Chamorro who's doing the appraising. They work in dollars, and so we need to know what the dollar flows are to Chamorro. And the first thing to check, it says somewhere, I think, if I can find it, yes, 3 paragraphs from the end of the first page, the last sentence says, all net cash flows from the project will be remitted back to Chamorro at the end of each year. So all of those peso cash flows, it'll all go to Chamorro, but we need to convert them to dollars. And of course, no problem there, because we worked out earlier what the exchange rates were. So, one thing about those exchange rates, of course, although I'm concentrating on B part 1, remember B part 3 wanted a discussion of assumptions made. Well, whatever else we can say, and we'll have a quick chat later, as we calculate the exchange rates, we were assuming not only purchasing power parity worked, because obviously there are lots of other factors could affect the exchange rates. So that's one assumption, but also, even accepting purchasing power parity, we're assuming that the rates of inflation will stay at 8% and 2%. So I've already got 2 assumptions there. So, as you're doing B part 1, be thinking about these things. Why not keep going back to the report and have a heading, assumptions made, and adding them as you come to them. Anyway, I'm talking too much again. Let's go back and finish the arithmetic. I made a note of those exchange rates to save me going up and down the screen. But the exchange rates, the spot rate now is 72, and the future years, 76.24, 80.72, 85.47, 90.5, 95.82. The figures that I'd calculated earlier. So let's now convert to dollars. And get it the right way round, remember times 0 is 2,700 pesos. There are 72 pesos to the dollar, and so we need to divide 2,700 divided by 72. I get 37.5. And state the fact that it's millions. There were millions of pesos, and therefore I'm divided by 72. Again, these are millions. And so, continuing for the other 5, 127.8 divided by 76.24 is 1.676. Inflow 500.2 divided by 80.72 is 6.197. 1194, 85.47, 13.970, 1005.2 divided by 90.5, 11.107, and finally 2298.9 divided by 95.82, 23.992. So, hopefully no problem there. However, 2 other things. Doesn't matter which order you think of them in. One is tax. It says, and it always says in this type of question, there's a double tax treaty. And here, remember, if there's a double tax treaty, if the tax rate in Chamorro is higher than the tax rate in a megum, or whatever it was called, then there'd be extra tax payable by Chamorro. On the other hand, if the tax rate in Chamorro is lower, well, there's no extra tax payable, but we don't get any back. Or which way around is it here? 4 paragraphs from the end. The tax rate in Megum is 25%. That's what we'd used earlier. The tax rate in Chamorro is 20. And so because it's lower, there won't be any extra tax payable. Again, though, we don't get any sort of refund. Now, it may look silly. I'm actually going to write it down. Tax, just, I don't know, perhaps I'm being overcautious, but just to prove I have thought about it. But because it's a low rate, there won't be any extra. If it had been a higher rate, not relevant here, but if it had been, let's say the tax rate in Chamorro was 30%, then you'd have had more work. We've only charged 25%. And so if it was 30% in Chamorro, there'd be an extra 5%. You'd have to calculate an extra 5% of the taxable flows and then convert that extra tax into dollars. But here, not relevant. Finally, now, something that's worried quite a few of you, it's a bit different than what's happened before. When we were setting up the flows in pesos, we had the extra $200 that was payable for special packaging. We'd done the converting, I'm not going to repeat that, but it was costing $200 a batch that they were having to pay to Chamorro. So Chamorro is receiving $200. And a lot of people want to bring in that $200. And as I say, in other questions, that has been relevant. But here it isn't, and the reason is this. That although Chamorro will receive $200, it won't be 200, it's number of batches and there's inflation and so on. But although they've got a receipt of $200 a batch, Chamorro itself produces packaged foods. Chamorro isn't actually producing the packing. It may not be immediately obvious, but what's happening is that Megum needs packing material, and instead of buying it directly, what's happening is Chamorro is buying the packing material and then charging Megum for it. So although Chamorro does receive $200 a batch from Megum, Chamorro's got to pay out $200 a batch to buy it in the first place. Right, it's $200 a batch, so the total obviously is higher, number of batches, inflation. And although you can by all means go through and work them all out, it's going to take a bit of a while doing, but the net effect is zero. Chamorro pays somebody for the material, then charges Megum for it. So as far as Chamorro is concerned, there's no net flow. And so those flows that I've got there, I'll erase the tax now to avoid confusion. These flows here are the dollar flows to Chamorro. They pay out 37.5, they get back 1.676 and so on. And so all that remains is to actually appraise those flows. Standard discounting. And here, there's one place he has been quite generous, although normally we'd have to work out a relevant cost of capital, you know, and quite possibly playing around with betas and things. Here he's done it for us. 3 paragraphs from the end, we're told the risk-adjusted cost of capital applicable to the project on dollar-based flows is 12%. So no tricks. The relevant rate is 12%. We'll apply the discount factors at 12%. And so, I hope the easiest bit of the whole question. The discount factors of 12%. Where are we? 1 year, 0.893. 2 years, 0.797. 0.712, 0.636. 567. And therefore the present values one 1.497, 4.939, 9.947, 7.064, and finally 13.603, giving at last a net present value of it's negative 0.45. However, remember it was all in millions of dollars, so I would actually write down it's minus $450,000. And there we are. So although we're not finished the question, I mean clearly that is the major bit, 14 marks. I think overall it is pretty straightforward. The problem is, quite frankly, is the speed. I mean, it's taken me quite a long time to appreciate. I've been trying to explain, I've been talking. I'd have been a fair bit quicker if I hadn't been speaking through it. But even so, there's a lot to do there. And although I hope each little bit of it's clear and shouldn't have been too much of a problem, the chances of having done all that and not made any silly mistakes when you're rushing, I think are tiny. You saw I would have made one mistake there. I mean, all right, I'm not worried about half a mark. It's irrelevant. And you don't lose marks twice, so one silly mistake makes the final answer wrong. But I still get full marks with how I've done my discounting, how I've dealt with working capital and so on. But because you're going to make silly mistakes, do take the trouble. It's a balancing act because of the time involved, but without being silly, do set out your workings nicely. I think my workings are quite neat, but most importantly, it's even if I've done something wrong, it's clear to the marker what I'm trying to do. Because I'm obviously trying to do it the right way. I'll get most of the marks. If I've made a silly arithmetic mistake, it's obvious it's a silly arithmetic mistake, and that's just half a mark here or there. Anyway, there we are for part B1. But of course, we've got B2 to look at in a second. Before we do carry on with B part 2 and finish the thing, two things. Remember, in your report, which I've said I would have made sure I'd already headed up a page, but the report wanted an estimate of the value of the project, so I could now put minus 450,000 into the report. It also wants to recommend an appropriate course of action. Well, although I may add something later when we've looked at part 2, for the moment, if Bullard's offer doesn't exist, then the recommendation would be not to go ahead because there's a negative net present value. It also asks for assumptions. Well, I mentioned already assumptions in getting the exchange rates we've used. Purchasing power parity works that those rates of inflation were correct and would stay at 8%, 2%, which in real life would be ridiculous. But also, all the estimates, revenue, the batches, how reliable are those estimates about the average number of batches we produce? How certain are we that we'll be able to increase the selling price by 5%. Similarly, the estimates of production selling, of training, and the applicable rate of inflation. All very, very standard MPV assumptions. The 5-year life, the scrap proceeds from the equipment, the land and buildings. There's a lot you could write down there. None of the things I've mentioned are particularly theoretical. They're all very, very standard. You know, even the tax rate staying at 25%. The fact that we're able to remit all the money. You know, have some sort of exchange controls in Meghan. It could mean in later years perhaps we can't remit the cash flows in full. Anyway, I won't go on with that. You can read the answer. However, let me move straight on to part B. Same project, but an estimate of the value taking into account Bullard's offer. And now we can read the bit about Bullard, which is towards the end of the first page. Second paragraph from the end. Chimura's finance director is of the opinion there are many uncertainties surrounding the project, has assessed that the cash flows can vary by a standard deviation of as much as 35%. And recently, Bullard offered Chimura the option to sell the entire project to Bullard for 28 million at the start of year 3. They'll make the decision whether or not to sell at the end of year 2. So it should have been very obvious from the wording and the fact you're given a standard deviation that this is an option pricing question. We need to work out the value of this option that's appeared. For part B, B2, sorry. For part B1, the option didn't exist. So it's either take it, the project, or leave it, negative MPV, reject. We've now got this option, and we've got to work out how valuable this option is. And the main thing here is not so much using the formulae. I mean, anybody can copy formulae from a formula sheet, and then it's just calculator work. The main thing for most of the marks is describing what option we're talking about and what figures go into the formula. And the first thing is surely, what is our option? Our option is that after 2 years, if we want, we're going to be able to sell the whole project. And so if it's an option to sell, surely it's a put option. Call option would be an option to buy, a put option, an option to sell. So here it's a put option. On the formula sheet, you've got your Black-Scholes option pricing model formulae. And there's going to be quite a bit to do here because we want the value of put option, which is the very last equation, P being the value of the put option. But in order to get it, we'll have to calculate C, which is the value of the call option, the first formula under the heading. However, all of that is sticking figures in a formula. The main thing is to know what figures we're going to stick in. And do make this stand out. There'll be a lot of marks just for this bit, whether you get the arithmetic right or you don't. So write them down the way I'm going to. PE, the exercise price. That's surely the most obvious one of all, that the option is to sell it for 28 million. So PE, again, as I've been doing throughout, I'll work in millions. PA is the current value of whatever it is we're selling. Now in here, he did actually help you. He didn't need to write the very last sentence, to be honest. But he said that recently Bullard offered Chimura the option to sell the entire project at the start of year 3. Now people get very confused over timings. Surely the first year starts immediately. Time 0. That's when the first year starts. The first year ends at time 1. In 1 year's time, And of course, in 1 year's time is when the second year starts. Second year starts in one year from now. Second year finishes in 2 years' time, time 2. And the third year starts in 2 years' time. It starts at the end of the second year. So it's at the start of the third year, the end of the second year, that we've got the option to sell. And of course, it'll be our choice. We'll already have had years time 0, time 1, time 2. Without the option, we then have to carry on and do 3, 4, 5. But here, we'll have the first 0, 1, 2. But it's then going to be our choice as to whether to continue for the next 3. Or instead to cut the thing and to receive 28 million instead. You know, what we do depends what's happened. You know, we've done our estimates. Clearly things may be even worse and we might as well sell it. Things could be a lot better and we might decide to carry on. But that's what the whole nature of the option is. At the end of second year, at time 2, we'll have the choice about whether to continue or to sell. Well, selling gives us 28 million. What is it we're selling? We're selling the remaining 3 years, and the current value of those, 9.947, the present value is 7.064, 13.603. The current value of them is 30.614. That's the current value, of what we've got the option on to sell. PA. What else do we need for the formula? We also need T, the time to expiry, the time at which we can exercise the option. Well, here it's going to be in 2 years' time. So this is always in years, so T equals 2. We need the standard deviation. That has to be given in the question. It is here. It's 35% or 0.35. And finally, we need R, the risk-free rate of interest. And you should be aware from other, ordinary capital asset pricing model studying, that the best approximation, all we can use here, the 3 paragraphs in the end, the risk-adjusted cost of capital, 12%, we've used that. It's considerably higher than the return on short-dated dollar treasury bills of 4%. Its short-term government securities give us the risk-free rate. So R is 4%, or for the formula 0.04. Now, although obviously for the full 9 marks, we're going to have to put them all in the formulae and end up with a figure. The examiner's not stupid. Putting them in a formula is just calculator work. And I'll do it, but I'm not going to waste time here. I'm afraid it's up to you to practice with the calculator. But equally, the examiner's not going to give loads and loads of marks just for being able to use a calculator. Certainly, just having written that down, knowing what the symbols, what we're going to use, that would certainly get me past marks for this part of the question. No doubt. However, let's have a go at sticking them in. Let me make sure I've got my formula in front of me. And again, check me. Same in an exam. The odd silly mistake, half a mark. To get P, we're going to have to do get C first. To get C, we need D1 and D2. And so, D1, you've got the formula. Let me make sure I stick the right figures in. It's log to the base E of PA over PE, PA 30.614 PE28 plus R 0.04 plus 0.5 times S squared 0.35 squared times T, which is 2, divide by S root T 0.35 times the square root of 2. Well, I said a moment ago, I'm sorry, but I can't teach you how to use your calculator, and so I am not going to spend the next 10 minutes messing around with my calculator. I've worked out the answer to that, and it actually comes to 0.589. You know, if you know what goes in, I'm sorry, I can't keep repeating the same thing. You must by now have a decent calculator, and you've got to make sure you can use it. Having got D1, D2 becomes easy, in that D2 is D1 0.589 minus S root T 0.35 times root 2. And this one I will actually do because it's so quick. The root of 2 times 0.35 equals 0.4945, is it? What am I doing? The root of 2 times 0.35 equals 0.495. I do apologise, it comes to 0.094. Remember, the sign of these matters in both of these are positive. I'll remind you what effect it has shortly, depending on whether they're positive or negative. But here they are both positive. To be able to do C, we need ND1 and ND2. Well, ND1 is looking up in the normal distribution, and a D1 was 0.589. Now then, the examiner's been very clever here, but I certainly wouldn't have done in the exam, and I don't think I'd have lost marks. If you look at your normal distribution tables, we need to look up 0.589 in the tables, but you're only able to look up to 2 decimal places. So I'm going to look up to 2 decimal places, that's 0.59. And for 0.59, it's 0.5 down the side. So I didn't explain. 0.5 down the side. And then as you go along, 0.50, 0.51. So it's the column 0.09. So for 0.59, I get 0.2224. Now, if you look at the examiner's answer, he gets slightly different. And the reason is that what he's done, he's been very clever and said, it's 0.589. So although it's nearly 0.59, it's a little bit less. He's apportioned between the answer for 0.58, 0.219, and the answer for 0.59, 0.2224. So, okay, his answer, it's slightly different and it's perhaps slightly more correct. But I wouldn't do that in the exam. You've got plenty of time. Fine, I wouldn't. And I'd be surprised if I lost any marks at all. Finally, before we leave that though, remember that whatever answer you get from the tables, if D is positive, you add 0.5 to it. Had D been negative, but it's irrelevant here, but had it been negative, you would subtract the figure from 0.5. Here it was positive, so we add 0.5, and it's 7274. Similarly, ND2. D2 was 0.094. The examiner has apportioned between 0.9 and 0.10. I would just do it to 2 decimal places to the nearest 0.0, which is 0.09. And looking at 0.0 row and 0.09 column, I get 0.0359. And again, it's positive, so add 0.5, 0.5359. Yet again, if you're checking the examiner's answer, it's a little bit different. I've told you why. I'm not worried. Having got ND1 and ND2, we can stick it in the main formula. So the value of a call option, PA, what did I get PA to be? 30.614 times ND1, 0.7274 minus PE, which was 28, times ND2, 5359, times, well, e to the minus RT. So I'll work this out here. E to the minus RT is e to the minus, well, R was 0.04, T was 2, 0.04, sorry, was R, T was 2, so it's R to the minus 0.08. And if I calculate that, 0.08 negative e to the power, I get 0.9231. Which gives me, sorry, we are nearly there, 30.614 times 0.7274, 22.269 minus 13.851, which gives me I think 8.418. I'm working in millions, remember, but I'll interpret it at the end. Finally, having got a value for C, remember we want the value, that's the value of a call option, we want the value of a put option, so it's the final formula, P equals C, which I've just calculated, minus PA, which was 30.614, plus PE 28 times e to the minus RT. When I worked that out a moment ago, it was 0.9231. Which after all of that, I get 3.65. Well, there's been rounding all the way through. I'll leave it at 3.65 million, remember, dollars. Again, it's a little bit different from the examiners. He got 3.4, but I've said why. And for the very last time, I'm not the slightest bit worried. I'm confident I'll get full marks. Finally, though, to get full marks, just one extra bit that's important. That is the value of the option. You see, without the option, we'd already done B part 1. Without the option, this project, if we go ahead with it, we get an NPV of minus 450, and that's why we recommended we wouldn't go ahead. But think what this option is doing. It's saying that if we exercise the option, then instead of these flows occurring, we still have that. But at the end of time 2, we'd get 28 million. And so we guaranteed to get at least 28 million. It could be that after that was a lot better or a lot worse, and we might not exercise. But the point is, things are uncertain. You see, at the moment, the present value of those, I can't remember what it came to. At the moment, we might decide, oh, it's not worth exercising the option. I don't know. But maybe, you know, if things get worse because of the uncertainty, then we'd exercise the option. So this option is worth something to us. And we've calculated that it's actually worth 3.65 million to us. Well, the project on its own loses us 0.45 million. Have the same project, but have this option involved, which is 3.65 million. It puts the overall value of the project up. The value of the project with the option it's whatever the project was already worth, which was negative. It was 0.45 million. Negative. In addition, we've now got the project with an option, which we've calculated is worth 3.65 million. And so the overall worth now is 3.20 million. So there's our final answer to part B. Subject, I said I wouldn't mention again, but subject to that rounding I referred to. But there's our answer to part B. B part 2, sorry. That the project with the option is worth 3.2 million. So now you can finish the report by, you can give the advice that without the option available, don't do the project. With the option, do it. It's worth 3.2 million to us. You can talk about all the assumptions. I mentioned several. The rest of it, read the answer, but I mentioned more than enough to get most of the marks. It did ask about extra risks that could be. I can't remember the exact wording. Here we are. Additional business risks that could be. Well, one risk I made, I refer to it as an assumption, but really a risk, is that Megan might not reduce its protectionist measures. Even if they do reduce them, they might put restrictions on remittances back to Tamura. As far as the option's concerned, there is one big risk there, that although Bullard's offered us this option, 28 million in time 2, and that's where our value came from, how confident are we that that option will actually be available? You know, what happens if Bullard goes bankrupt before 2 years are up? And so the option disappears. Or what happens, if Bullard refuses to buy us? We've done all that assuming we can certainly get 28 million if we choose to exercise the option. So there's, more risk.